Alright, hello guys, I'm Shlomo Cooper and here we are in the weekly webinar, and today we are going to talk about trading like playing poker. And before we start, I just want to make a sound check. Can you hear me bright and clear, or am I muffled? Please tell me if everything is alright. Just print yes or 1 on your keyboard. Everything is perfect. Alright, bright and clear. Great. So before even starting, I just want to put an instant poll here in the room. Do you play poker? Just to know what is the situation is here. You know, many people are fans of this game. So just click on your answer. 1 is yes, I love this game. 2, no, it's only for gamblers. Alright, and we have all the results. Alright, and the results are coming out. And it sounds like about 57% of you are not playing poker, but that leaves 45% of you do play poker. Alright, and I just stopped the poll. This is interesting information for me. Anyway, I just have to tell you that you don't need to know anything about poker coming to this webinar. So, you know, for several years, playing poker has been getting increasingly popular and has been compared more and more to trading. But the question is, are such ostensibly very different activities at all comparable? And quite clearly, my answer to that is absolutely yes. They both share certain elements of luck that cannot be influenced by any trader or poker player, such as the movement of the market or the cards that you are dealt. But they also have in common many other parameters that can lead to success if used intelligently. Just like a professional poker player, a trader also needs to learn not to be guided by his emotions. Instead, he should know in every situation when to raise or lower his stakes, or maybe to pass instead. You know, one of the best elements a trader can acquire is to know when not to act, when to sit on the sidelines and not to make the next movements. Not because it's not going to work, but because maybe the trade right now on the deck doesn't fit the trader's risk profile, and we are going to talk about it later in this webinar. So both traders and poker players need to have sophisticated risk management. However, this is not what this webinar is all about, not at all. Playing a successful game of poker means being able to wait for the right moment in time and risk making your move only when conditions are perfect. So this webinar is designed to show you that such an approach can also lead to significantly better results in your trading. And what I say is, learn to play poker when trading. It is worth it. So let's start. Poker is a game of chance for many people. But this is not entirely accurate. Of course, having a good deck of cards is part luck, since this is the only element of the game that you cannot influence yourself. Other than that, though, it is entirely up to the player himself what he makes of the cards he has been dealt. He can pass or initially call in order to study the behavior of the other players. He may try to bluff or use his hand to gamble on winning. The important thing is that in every possible situation, he can make an intelligent assessment both of his own and the other players' available resources and act or respond to them accordingly. Since you are never dealt a good or bad hand all the time, it changes over time. One time you are a lucky guy, and the next time you are dealt bad cards. This is not only a matter of luck, but what matters is what you make of the situation at hand over time. So playing poker, so let's connect and tie playing poker to trading. And that is exactly what a successful trader does. What the opponent is to the poker player, the chart is to the trader who uses the chart to read the mood of the market. Slight differences in momentum, the various instruments of technical analysis, as well as the prevailing volatility, actually tell the trader what the current frame of mind of the market participants is like. Through his own market analysis, the trader knows the degree of probability with which the signals he needs will occur and how to trade these signals. Now, based on the prevailing market situation, it is decided whether an entry should be made or whether to pass instead. First, though, a determination should be made on the stakes, which means the maximum allowable risk. What is the risk I'm willing to take on the current trade? Only after that should an optimum entry be made to arrive at a minimum risk with a relatively high chance of winning. Thus, the trader plays poker for a good risk-reward ratio, and this is what we are going to call it in this webinar and in trading at all. RRR is the short of risk-reward ratio, and this is what we are trying as poker players or as stock traders to achieve. And that means the amount of profit can be gambled on again by increasing one's positions, and we are going to see this concept of pyramiding, building a position, pyramiding a position later on this webinar. But clearly we can see here that the similarities between trading and poker, there are similarities since in both disciplines you have to invest your money intelligently and at the right moment in time. So what does a trader need? What does a trader need in order to play poker? For poker, a trader usually requires a trading approach that allows him to plan trades in advance and place limit orders before the market reaches certain levels. So as a rule, this is hardly possible with entry signals based on indicators, and can only be done by using instruments of technical analysis such as resistance and support lines, or Fibonacci retracements, or I don't know, VWAP maybe, or pivot points. So for this reason, we will focus in this webinar on resistance and support levels. And I just have to say in advance that this webinar is actually aimed to traders with experience. If I need to grade the difficulty of this webinar, I would grade it as high level. But most of the traders here in the room are traders with good approach and good level already, and this is our mission here in the trading room, to push you to achieve even higher levels. So in this webinar, I'm going to focus on resistance and the support levels, and in particular we will consider the previous day's levels, such as the previous day's close, the previous day's high, the previous day's lows, as well as the current opening level, since these play an important role in short-time trading and are always sought by the market. So as day traders, we are always considering these levels. Furthermore, good market experience is an advantage. Traders should know precisely the degree of probability with which a given market scenario will materialize, and only then can they create an appropriate risk to reward profile of the trade. For this purpose, it is useful to start a statistic on behavior patterns of the markets or stocks to be traded, and again we are going to discuss this and to see some examples later in this webinar. So let's start, and I want to start with playing poker for a good RRR, and again RRR is the short for risk reward ratio, and let's talk about strategy of making an entry in retracement. Now, how does a trader play poker for a good RRR? A trader plays poker by trying to achieve a good entry with the least possible risk. That could, for example, be done by an entry in drawdowns, when we have a pullback, when we have a series of red bars against an uptrend. Since entry and stop levels typically tend to improve while target prices remain unchanged, the RRR increases automatically in such situation, and this is calculated as follows, and we can see here the formula: entry minus target price divided by entry minus initial stop. This gives us the RRR, the risk to reward ratio. So let's go to figure number 1. And this is, by the way, a trade from yesterday, DM. This was the IPO, but you know, this is a concept, and actually I can take almost any chart and to show you, and this is a concept you should be able to implement on any chart from now on. So look at figure number 1, and you know, most traders wait for a breakout above a resistance or a support level, which is this trade number 1. And so trade number 1 goes above the high. So we can see here the first 5 minutes candle, and this is DM for the 5 minutes candle. Above the first 5 minutes candle, we can see here one green bar and another green bar, and the third bar of the day, this is the second green bar in a row, actually send a big topping tail above, all right, and then the stock is going sideways, a little bit digesting the high price it has just reached, and then it's breaking the high of the day, going above the tail, the upper tail. All right, so this is the breakout strategy, very, very simple and elementary strategy. But so this is the breakout. But you know, such trades, more often than not, though, such trades are made within an increased momentum, resulting in inferior execution. And as you can see, the breakout here was with great momentum, and usually it's causing the trade to be more expensive as a result of a slippage. And the meaning of a slippage is that you wanted maybe to enter above 24.50, but because there was a great competition over the stock, actually you were able to get your entry at about 24.55 or 24.56. That means you had something like a 5 or 6 cents of a slippage. This is making the entry point more expensive. Also, most false breakouts can therefore not be detected until very late or not at all. However, if a trader knew from his own statistics that he keeps that following a break of a resistance support line, a market is liable to return to that line in about 70% of all cases. Then the trade could be planned totally differently. In this case, it would be worthwhile to initially allow the resistance support level to be broken, and not to carry out the trade until a pullback to that line occurs. So in trade number 2, we are not participating in the first breakout, but we are letting other traders to jump in the waters, and we are waiting for a pullback. We are waiting for a retracement to show on the chart. Incidentally, most professional traders make their entries during drawdowns, and in figure 1 it can be seen that this kind of entry makes it possible for the target price profit to be increased by 81 cents per share, and for the stop level to be reduced by an amazing $1.29, and we are going to go over the figures in 1 minute. So the fact that the RRR can be increased by more than 4 times from 1.17, this is the RRR for trade 1, to 5.2, this is the RRR for trade 2, and for trade 2 we are waiting for the pullback to complete, and then we are taking the reversal. This is actually clearly showing you that playing poker is worth it. So I'll go now in depth of these 2 trades. Trade number 1 is the elementary trade. Everyone knows to do it. We are waiting for a breakout high of the day. We are placing the stop below the last support, or here below the last major bar, which means around the 22.71. This is the stop. The entry is 24.50. We are placing the target, and the purple line here is the same for trade 1 and trade 2. This is the profit target for both trades. We are not changing them, and as we can see, the trade breaks out, but it doesn't reach the target, the profit target, and then it pulls back, and actually it does what we like to call it as professional traders. It makes a retest. It's coming back to visit the breakout level, and as I said, 70% of all breakouts tends to go back to visit and retest the original breakout level. So if 70% are doing so, why not to start to initiate a trade only when we have a pullback back to the prior resistance level that now act as a support? And as we can see here, what we are doing here is to place an entry above the high of the last red bar with a stop not exactly below the low of the bar, but I'm taking even a security distance and placing the stop below the VWAP and below the round number. So the stop here, so the stop here is $24. So on trade number 1, we actually risked $1.79 per share when the target profit, the purple line, is set at $26.60. That means we are looking for a profit of $2.10 per share. This gives us an RR of 1.17 for trade number 1, whereas trade number 2, our entry point is 24.54. Keep in mind that this is, pay attention that this is very, very close to the entry of number 1, and this is not by chance. This is because we are waiting in this poker entry, waiting for the price to go to visit back the initial breakout level. So this is similar to the first entry. Stop here is $24, much less. We are risking only 50 cents per share, whereas on trade number 1 we risked more than 3 times this amount. Target profit is the same as target profit of trade 1, and on trade 2 is set to $26.60. So we are waiting for a target of $2.10 and 60 cents. So in this trade, actually, I risked much less, only 50 cents, but my target profit increased because I didn't change the target, but I was able to take the trade, to initiate the trade at cheaper price. I was able to start it at cheaper price. Okay. All right, so if to summarize, this is a successful method to improve the IRR. Professional traders almost exclusively enter the market during drawdowns, since markets frequently returns to the resistance support level after breaking that line. The benefits of this approach are shown in figure 1, and this way the entry level will move closer to the resistance support line as in trade number 2. The stop will continue to be higher than the last support, giving us the opportunity to risk less, and the gap between the entry level and the target price can increase. In this case, actually, it didn't increase, but it may increase if the pullback was deeper, and then it would give us an opportunity to initiate a trade at cheaper prices. Okay, let's move on and let's talk about entry prior to a breakout, and this is strategy number 2. Another way to improving your IRR is an entry made prior to breaking a resistance support level. If the market rebounds from a resistance support level, all right, is rebounding before a break, a trader is also given a good chance to play poker for a better IRR. This is illustrated here by figure number 2. And more often than not, the market moves slightly above a resistance support level in such a rebound. If traders make an entry too early and trade a breakout, let's say here in NPSP, a 5 minutes chart, the stock yesterday started to climb up, and here we can see one boom bar, one very, very high bar. It closes at the high, and there is a large distance from the opening level to the closing level, and usually institutional money is the kind of group that actually creating this kind of bars. Then we can see another boom bar, another very, very large bar, and here we can find here a very nice cup and handle, or if you would say a cup formation for a breakout. This is a breakout strategy, very simple breakout strategy above the high. But you know, if you are going, but if traders make an entry too early and trade the breakouts, and let's say this tail, this upper tail actually went above the entry, so it would it would get you in. They need either a very large stop, or they will fall victim to a false signal, and the previously set stop will be triggered. And again, the motto is playing poker means catching the right moment. The trader will wait for a minor bottom to form after the rebound. This is the bottom. Here is the first rebound, and this is another bottom. All right, and most preferable is that the post rebound movement not being too dynamic, but rather on the quiet side, like we see here. So the rebound here is on the quiet side. Then the market will again rally slightly, which is the moment to enter a trade. So here we are not getting into the trade above this green line, the breakout line, but we are waiting for the market to pull back a little bit, and then we are initiating our entry just before the breakout level. After all, the minor bottom has caused a good and useful stop level to be reached slightly above the most recent low. At this time, there is a very high degree of probability of a breakout occurring above the resistance level, above the green line here, since there is no downward trend momentum there after the rebound. It makes sense to set the stop level below the most recent low we see here, since the market should not fall below the last low. Otherwise, there would rather be a greater likelihood of a trend reversal occurring. Pay attention that the target price again is the same. All right, this is the purple line. This is where I set a fixed target profit. And the RR, and if we are going to look on the trade, so trade 1 entry is 24.54 above the breakout. The stop is 23.90, 64 cents below the last major bar. All right, target profit is set at 25.35. That gives us 81 cents of distance, and the RR, the risk reward ratio, is set here at 1.27. On the other end, on trade number 2, trade number 2 gives us the opportunity to initiate a trade prior to the breakout, all right, at a cheaper level, cheaper prices. The stop is about the same. So here the stop is $24, slightly above the previous stop of $23.90. The entry level is also lower, $24.25 in comparison to $24.54 on the previous trade, and that gives us an RRR of 4.4. So the RRR achieved here is 4.4, which is 3 times than the RRR on the breakout variation in trade number 1. And again, it is worth your while playing poker here for a better entry. Let's talk about the expected value in playing poker for a pullback, and this is what we saw in the first strategy, where we are waiting for the retest to occur and we are just letting the breakout to go without us in order to achieve a better RR. So to be sure, there are 2 sides to every coin. If, as a trader, you play poker for an entry, you will not get every trade, since the market does not return to every broken resistance support level each and every time. And we said it only occurs 70% of the time. This is where the calculation of the expected value comes into play, which requires a statistics to be kept and evaluated for both variations. And this is an example, and I really urge you to do it on yourself in order to start seeing in your own eyes what is your risk profile and what is the best tactic to use when trading for you. What works the best for you from the mathematics point of view. And at the end, everything is mathematics, you know. At the end, at the end, you are coming to the cashier to cash out, and the cashier is just going to count what you made along the day. Okay, so based on the evaluation, the trader then receives the calculated average values, allowing him to identify the corresponding expected values of the 2 strategies. So this is what we are seeing here in table number 1. In this example, it is generally assumed that around 25% of all signals are false ones, and so in the case of a direct entry, 75% of the signals are hits, and an average profit of 40 cents will be made. In case of false signals, as we can see on the table here, you will be stopped out, making an average loss of 25 cents. So the expected value of this strategy therefore stands at 23.75 cents, and the calculation is as follows. We are just multiply 75% multiply by 40 cents of the profit, and we are adding to that 25% chance of losing 25 cents per share. This gives us the expectancy, and the expectancy here is 23.75 cents. If we are going to multiply it by 100 trades, that gives us 2,375 cents. This is per share, of course. All right, 100 trades multiplied by 23.75 cents per trade. This gives us 2,375 cents per share. And if, for example, let's say our average share, our average position in one of these 100 trades is 500 shares, this comes to about $11,000 or $12,000. You can just calculate it in the calculator. Now, what about the expected value when using the poker strategy? And on the right hand side, we have the poker strategy figures. Here, 12% of missed entries are added to the 25% of false signals. All right. However, the improved entry causes an average profit of 60 cents and a lower average loss of only 20 cents to be made when we are going on the wrong side. So based on this calculation, 71% multiplied by 60 cents per trade, per cents on a winning trade, plus 29% of losing trades multiplied by 20 cents of a loss per share. This gives us an expectancy of 36.80 cents per share. If we are going to multiply it by 100 shares, we are going to get 3,680 cents per share on a total of 100 trades. And you know, and this is about, and if the average position is 500 shares, this gives us a profit of about $18,000 over 100 shares. So you can see here that the poker strategy is actually not just that the profit is bigger. Yes, we are paying with the accuracy, because the accuracy is going down to 71% in comparison to 75% on the direct entry, but we are getting compensated by a larger profit. Also, we are getting compensated by a lower loss when we are wrong, and the expectancy therefore is going higher. As a trader, you can try to make many trades in order to achieve many small profits. And in general, however, both the risk and the chance to win are always similarly high. If you have a losing streak, this will quickly lead to large losses, which cannot easily be compensated for by many small profits. But what if you could achieve a multiple of earnings with a normal stop level? To achieve this, a trader needs to be able to play poker for a trend. This is playing poker for a trend. The markets move in trend phases only 1/5 of the time. So it is not easy to find a trend. This means that traders must expect a lower hit rate, and the question is it worth it? And let me give you the answer early: yes, it is. it is also worth playing poker in the third case, in this third case of playing poker for a trend. To do so, though, you have to be in a position to pyramid the trades, and that means to gradually increase your position by making partial entries. So here on figure number 3 and 4, and which we are going to see in the following slide, I will show you how this is done in practice. This is how you implement partial entries in day trading. Traders should try relatively early in the morning to find the initial setup, and here we are going to see a pyramiding on the simple breakout strategy as we started this webinar with. So we first of all trying to early in the day, in the morning, to find the initial setup, and let's say we took the same trade of NPSP from yesterday, and the stock starting by opening up with the green bar, going slightly downward, then it's going back to the high, and here it comes to the high of the day, to the first major resistance of the day, and this is the entry, this is the breakout entry. Only then it is guaranteed that you can completely follow one day's trend. The first position size is determined by normal money management criteria, with the position risk lending itself to being set slightly higher than normal, since you would want to execute only as few trades as possible. So let's say if the normal shares you are about to take on a regular trade is 400 shares, here you are going to increase it a little bit to 500 shares. So in entry number 1, you are taking 500 shares. After that, the position size should be halved with any additional partial entry. For example, a half, then a quarter, and then 1/8. This way, the profit made on the previous positions will not be completely lost again in case of a triggered stop. Once the next setup is there, and as we can see, the stock climbed higher, it reached another resistance, now it's going sideways, and here it has the second breakout formation. So on entry number 2, now we are not going to take the full position of 500 shares, no, we are just cutting it by 2, and we are just taking half of it, 250 shares on the second position. All right, so and this is how we are building the position. Always next position is half of the recent position. The stop of the new position will be placed according to the criteria governing the setup. So the stop for the previous position will be adjusted to the stop level of the new position. For example, here is the initial stop of entry number 1. When we initiate entry number 2, we are going to place a new stop below the recent low for entry number 2, but this stop is also good for the whole shares, so it also fits for the first 500 shares we took earlier. The scenario can be repeated until the market stops out the entire position or a temporary exit is made. So for example, here we had here a third entry with only 125 shares, which is a quarter of the first full position. All right, about the high of the day here, the stock breakout above entry number 2. It's going higher, it's consolidating here at the highs, it's sending a little lower tail here, and then it managed to break out this bull flag. So this is the third entry of the day on this position, and we are increasing right now the stop on all the position below the last consolidation. And now, as you can see, there is one major bar of a breakout, but then the stock is starting to drifts back, and then here, around here, the stop is getting triggered and we are out of all the position. And as we can see on entry number 1 and on entry number 2 we made money. On entry number 3 actually we lost money, but we lost money on the tiny shares, and on the major shares, on the big shares, we actually made decent money. So the ratios of the strategy evaluation, and let's see the poker strategy right now with pyramiding. The poker strategy, I'm taking the same chart of the breakout strategy, but now we are using the poker strategy, and the poker strategy here is to buy the pullbacks, is letting other traders to jump on the first breakout and waiting for the breakout to retrace back to the retest level, back to the initial breakout level, and then we are seeing a change from a change of the resistance level to a support level. This is where we want to find a reversal and to jump on the trade. So for example here, the first trade is in a purple line. This is where a breakout play would be, but we are not taking it. We are letting the breakout to go. Then we see a pullback, and then we are buying the pullback. So here is a pullback, a retest of the recent highs, and this is what we are buying. This is our entry number 1. And again, there is another breakout. All right, another breakout to new highs. Then the stock is consolidating, going sideways, and now there is a new breakout formation appears on the chart. Instead of just jumping on the breakout strategy, we are waiting for a retest of the last breakout level. So just see how the stock is going back to visit the recent breakout levels, and this is the pullback and the reversal bar, the hammer candle. We want to initiate our position. This is the entry number 2. Only now we are just taking 250 shares, because on entry number 1 we took 500 shares. And again, we let the stock move, and here's the breakout. Only we are not risking if the breakout is going to succeed or not, because we are just initiating the position ahead of the breakout. The stock is climbing really nice upwards. Then it's going back to the recent breakout level, the purple line, and here we can see another reversal on the retest level. All right, back when the price is going to visit back the last breakout level. So this is another reversal. This is the third entry with 125 shares. So this is exactly the same chart as on figure 3, only the entries are different. On figure number 3 we are just playing the simple breakout strategy, whereas on figure number 4 we are playing the poker strategy, okay, which is absolutely more sophisticated. Alright, so we are putting all the figures, all the ratios of the strategy are now on your screen, and we are comparing the poker strategy to the breakout strategy. So on figure number 4 we had the poker strategy, number of trades 3, winning trades 3, hit rate was 100%, average RR is 3.8, and this all gives us a total profit of $1,710, whereas the same chart implementing the breakout strategy gives us only a hit rate of 67%, because one trade was a losing trade, and thus that leads us to a nice profit, but much less than the poker strategy profit. Again, this is the same chart. Conclusions. So waiting for the right moment is key, both for poker players and traders. Only if you know when to miss a trade rather than take too big a risk can be, rather than take too big a risk, can you avoid excessive losses? And only if you master the patience to wait for the best entry will you achieve a good RRR in return. What impact this approach can have on performance is shown only too clearly by the examples we showed. Even if partial entries were not to be used, the poker strategy in this situation, if we are not using the partial entries or the pyramid strategy, the poker strategy here would have a significant impact on overall performance. There are also psychological benefits to the strategy used in poker. Psychological benefits. When you trade Breakout, the position usually moves into positive territory initially. However, the price will bounce back at a rate of 70%, causing the position to move from positive to negative territory before moving into the profit zone again after the pullback. This variation means that that traders will experience an emotional roller coaster and are in danger of ending trades too early. If you learn as a trader to play poker for your profits, this will not only hold out the promise of a marked improvement in performance, but will also be of psychological benefit in significantly helping you to relax. Guys, hoping this is useful information. If you want to have this this presentation, you are more than welcome to send me an email to shlomo@tradenet.co.uk. Since I'm short in time, I won't have time to take questions, but if you have any questions, feel free to send me an email to get this presentation or any question that is raising according to this webinar, and I'll be happy to answer you. Thank you very much for being with me for the last hour. Wish you successful training here, and I see that Agi is here to continue the day, and I'll be here with you next week with the next weekly webinar. So good luck everybody, and see you all.